Hey traders, Alex Ong here, and I am back with a new video for you all. I know I've been away for quite some time now. I've had a couple of things that's been going on, which I won't bore you with now, but maybe at some point I can talk to you all about it. But anyway, I'm back ready and raring to go. And what I wanted to do to start off some of the new videos I'm going to be bringing you is just kick it off with a really fantastic trading tip that you can use whether you're a day trader or more of a swing trader to basically improve your strike rate and improve your odds of success. It's very simple. It's a straightforward concept, but I think it's something that too few traders really kind of take a look at, and that's this concept of key levels. Okay, so we know that we look at support and resistance levels and people like, buy support or sell resistance and all of that, but they don't really think about the psychology behind it. They don't really think about why these types of trades work. And I think if you kind of really understand and you really get into the trade, then you'll have more confidence in it, and obviously then your trading will improve. And if you look at this from a day trading perspective, then I'm giving you a way to literally immediately eliminate half of your losses, because if you follow this principle that I'm about to show you, you will take out the ability for the market to hurt you by you trading in the wrong direction during your day trade. So this video is going to be about increasing your odds, whether you're a day trader, a swing trader, or whatever it is that you want to do. So anyway, let's jump over to the charts and really just look at an example here. Now, I have the dollar yen in front of me. You can see that I've got three charts here. The moving average is not important here. Even the chart timeframes, I guess, aren't really that important, because you can apply this principle to any time frame. Now, what we want to do, okay, is we want to be looking for key levels on the longer term charts, i.e. something like the daily chart or the 4-hour chart. Now, I know that I said that the time frame doesn't matter, and what I mean by that is the time frame doesn't matter for the chart that you're going to be trading. So you'll pick your key levels on the longer term chart, but then if you choose to apply the principle to a 5-minute day trading chart or a 60-minute swing chart, it really doesn't make a difference, because you will be putting yourself in a position to be taking higher probability trades, which means that obviously your strike rate is going to go up, your win rates, you'll be winning more trades than you lose, and then hence your bottom line will be affected as well. So it'll be impacted in a positive way. So you'll have more money in your account, and hopefully for those of you that have been struggling with trading for a while, you'll start to be able to actually take money out of your account, as opposed to be putting in it and topping it up all of the time because of your losses. So anyway, let's go back to this and let's pick a daily chart, all right, as our chart to pick the key levels. Now, what you want to be doing, right, is you want to find key levels that that the markets pay attention to. And I'm not talking about these kind of smaller, insignificant swing levels like this guy over here or this guy over here. I'm talking about the major levels that the markets have reacted to in the past and will react to in the future. So if we kind of go over here, and let's say that we're over here in the past, okay, so the 11th of May 2017, and I've seen that this high has been posted there. I could then put in a level, okay, and say, well, the next time the market comes to that level, I'm going to do something, all right? And then I could, from a support perspective, I could put this level here. I've got a more recent level in over here, which we can look at later. But basically, you're just putting those major levels that the markets have reacted to in the past, and you think they'll react to again. Now, once you have these levels in on your chart, okay, it's all about understanding what to do with them. Now, actually, let me go back into the daily chart here for a second. What I want you to notice, all right, is that when the markets come to these levels, and I know that you may be thinking I'm teaching you to suck eggs now, you know what support and resistance is, and I appreciate that, but what I want you to think about is what should be happening at these levels, okay? So support and resistance levels are levels where the market participants, the big players, okay, have taken a stand. So if we look at this resistance level, the market had been rallying all the way up from 108.24, all right, which is the beginning of this move, all the way to 114.29. And this is the level that the sellers got involved at, okay, and they said the market is not going any further, so we're going to sell it down below. All right, we're going to sell it back down. The next time the market comes up to that level, we need to try and get into the heads of these big players. All right, and what I mean by that is we need to start to think like them. So how do we do that? Well, let's say that we've got this, was this on the 11th of July 2017. So now let's go down to a shorter term time frame. Let's say the 4-hour chart. Let's try and get to the 11th of July, okay? So we'll go in here, 2017, July. Okay, oops, that's not July, is it? All right, let's do it like this, 2017, July 11th. So in and around there. Let's go to this time, right? So this is the, in fact, let's try and do it on the 1-hour chart if we can get back there. Let's see if we can go back that far, because it'd be much, much better if we do that. Good. Okay. So the idea is to be trading big levels, okay, so from something like the daily chart on a shorter term time frame, so something like the 1-hour chart, or if you're a day trader, you can even go to like a 5-minute chart. And what we're looking to do here, okay, is we're looking to say, okay, the market has come up to this resistance level, which is the last place that the sellers got involved in the market. This is the last place that when the market rallied, the sellers said that it's going to go down, okay? Now, when it comes to this level, one of two things should happen. Either the sellers get involved again and they sell the market down, okay? Or the sellers say, no, we're not going to do this, okay? Or maybe they try, a couple of them will try, and they'll put their stops above the level, which is logical. But actually, the buyers win, and then we get a rally on up above the level, okay? So what we're looking to do is we're really looking to kind of monitor the price action at this level here, okay? We need to see what happens at this level. So we're looking for mini support and resistance levels to appear at the major level, if that makes any sense. So we know that we're looking for a reaction to 11429. Now what we need to do is see what that reaction is. So we don't just sell because the market gets up there. We wait to see what the market does. And what we say to ourselves, all right, and this is key. This is the key point here. What we say to ourselves is that if the market trades below this level here, being this major level there, if the market trades below there, we need to be sellers. We need to be selling the market below this level. If the market trades above there, we need to be buyers. Now, we don't just sell and buy willy-nilly. We wait for support, and as I said, mini support and resistance levels to present themselves. So in this case here, when the market came up to this level, it sold off a little bit and then it rallied. So it gave us a mini support level. So what we could say is that at this level here, that's where we want to sell below, okay? So the market's already tried to get below there. It hasn't done it. If it does get below there and it trades or it closes below there, then we want to be a seller. By the same token, the market's come up here and it started to post a bit of a high. It didn't really quite do that, all right? So it's tried to get above there. And then it's traded back below this level and it's closed below this level, okay? So what the market is telling us is that whilst it tried to get above this level, if there were really buyers involved in the markets, they would be able to consume all of these sell orders above here and push the market up in that direction, okay? Push the market up here. But it didn't manage to do that. It closed back beneath the level. And then we said that if the market breaks beneath this level, then we want to be a seller. So when the market closes beneath this level here, okay, this level here, we want to be a seller. So we sell below there. We have our stop above the high over here. Okay, so the stop above this high, and then you can either trade to the next support level, so maybe trade down to here, which will give you much more than a 1-to-1 risk reward. You're more like a 2-to-1 risk reward, or you can kind of trail your stop or something like that. All right, but that's kind of the basic concept, right? That's the general concept that we're looking at. And this stuff works over and over and over again. So if we go to the next time the market gets down to support or resistance level, so we can see that it trades down from the support level here down to, from that resistance level down to this support level. All right, let's zoom in a little bit closer. And again, what happens? So the market gets down to this level. And what do we say? We say if the market trades beneath resistance, all right, gives us a setup beneath this level, then we want to sell the market. If it gives us a setup above this level, then we want to buy it. Okay, and again, what do? So we get our little pen here and we say, well, we need to look for support and resistance levels in and around the major level. This is a major level. Here is a resistance level. So I'm going to say that if the market, okay, can get above this level here, I want to be a buyer. No price action took place down below here, so I didn't have anywhere to say that I want to be a seller. So the price action took place all above this level, which is a clue that actually in the long run, the market wants to go higher. all right, that the buyers are in control. And then what do? You get involved when the market breaks that level. So you get involved at around this point here. Okay, you have your stop below that point there, and then you can look for the next resistance level, which could be this guy over here, which will give you kind of like about a 1-to-1 risk reward, or you could trail your stop. Again, the targets aren't important. The entry method that you use isn't necessarily important. That's down to you. That's personal taste. But the important thing to remember here is that when you're trading at key support and resistance levels, which is what you should be doing it with a view to saying that, you know, you want to be long above a level or short below a level. And what that will ultimately do is that will eliminate the unnecessarily losses that you take. So because if you imagine that you're one of these, that you're sort of like a retail trader that loses money all the time, what they do is they're like, oh, I'm going to buy, sell, buy, sell, buy, sell. They don't have any real plan. Whereas if you say to yourself, again, and this is really what I want you to get from this video, if I'm above this level, so we're at this resistance level here, right? It's a key level. If I'm above this level, I want to be a buyer, all right? So I'm going to look for only buy setups above this key level, all right? So really I'm looking for some sort of a move above there. Then I'm going to be a buyer. Below this level, I'm only going to look for sell setup. So I could say, well, let's put that level in there. So we've got a little support level in there. So I'm looking for sell setups. I don't get the buy setup in this instance. I get the market closed beneath this level. So that's a sell setup. I can then sell the market here. Okay, and again, I could look for the next, get rid of that there. I could look for the next support or resistance level. Okay, so I could say that this here is a support level that I want to trade to. That will give me about a 1-to-1 risk reward. Or I could go down for this support level there, which will give me like a 3-to-1 risk reward or something, you know, ridiculous like that if I traded down to this resistance level over there. But the point is that these patterns play out again and again and again in the markets. It's such a simple concept, all right, but it's a concept that is going to make you money in the long run. It's going to up your strike rate. It's going to increase your probabilities of trade success. Okay? So I hope you enjoyed this quick tip video. Again, as I said, sorry I've been away for a long time. Hopefully, you know, things will be back to normal and I'll be able to post many more of these videos here. But for now, have a fantastic day. Really take on board this trading tip. Watch the video again if you need to, because I promise you in the long run, it's going to help you. It's going to be something that's going to increase your probabilities of success with your trading. So thanks so much for watching and have a fantastic Wednesday. Take care now.